Okay, so as Long mentioned, I'm going to try to motivate pretty much what Joseph said about the future of uh, blockchain and finance, or maybe I should say the future of finance and blockchain. And I'm going to try to fill in some missing pieces because I don't think we're there yet in terms of uh, infrastructure. So the title is New Finance Needs a New Form of Treasury Note. I'll get to that, but basically, I think we're missing the type of stablecoin that we need in order to run new finance. And in order to do that, a new type of treasury security is needed to form a backing for stable coins. This is an idea that I had with Don Wilson, who's the CEO of DRW and one of the largest players in blockchain finance, as I'll explain. So just to set the landscape for a minute or two, this is a chart from Citibank's recent forecasts of the growth of stablecoin issuance globally. It's almost all US dollars, as Gordon said. And so far, it's virtually all for cryptocurrency trading. That is, where the asset that's being traded against stablecoins are cryptocurrencies. But as Citibank forecasts, there are new applications coming in the use of international US dollar cash. That's already happened. The stablecoin sandwiches and cross-border payments in stablecoins. That's the green, and increasingly the use of US dollars in the form of stablecoins in emerging market economies. So countries where the banking system is weak or inflation is very volatile, consumers and businesses are switching to some extent to using stablecoins rather than their local currencies. And that can be good or bad depending on whether the country deserves to, or their citizens deserve to have that sort of treatment. That's not my topic for today, but you can see that that's a potentially very large use of stablecoins. And USDC, for example, is very well positioned to take advantage of that. Uh, I'm not going to say anything about the blue. It's Citibank projects it's going to grow. That is the use of stablecoins in the cryptocurrency markets is going to grow. I'm not all that excited about that, as opposed to probably almost everybody else here. I don't think it's that interesting to invest in cryptocurrencies. And so, since I don't think I'm planning to invest in cryptocurrencies, I won't need to have stablecoins in my wallet as a medium of exchange. The price earnings ratio for virtually all cryptocurrencies is pretty much infinite, meaning there's no earnings and there's a high price. But the red part is really interesting. Uh, could we end up in a world in which, even in a developed market like the United States, people will start to substitute by moving, by instead of using US dollar deposits in banks, will they start using stable coins? And here again, I think I might diverge from many people here in that I think there's really only one killer application inside the US domestic economy and probably in Europe and the UK as well for stablecoins. And that's exactly what Joseph was talking about. New finance. Finance is going to be built, a lot of finance is going to be built on blockchain, and we need a cash medium in blockchain in order to run finance. And that cash medium is almost by definition either stablecoins or something virtually like a stablecoin. And right now, I don't think tokenized deposits are going to be suitable for interoperability reasons and competition reasons. And I don't think the US is going to issue a CBDC. And it certainly won't be on a blockchain anytime soon anyway, anywhere, including China. So what does that leave us? I think it leaves us exactly where Joseph began, which is traditional finance is going to move on chain, and we need stablecoins to do that. I'll give you one example and then another example, and then I'll tell you what's missing. So one example has already been tested, and that's cross-border FX in wholesale exchange. So a U.S. bank, for example, wants to buy 400 million euros. It's going to pay with $500 million. Well, if the if the U.S. bank sends over the $500 million, maybe it won't get back the 400 million euros. And you might say, well, that would never happen in the world of banking. People are too careful to send hundreds of millions of dollars without having received hundreds of millions of the other currency. But that's exactly what did happen in the 1970s when Herstatt Bank failed. Citibank, in fact, lost 620 million for itself and its depositors when the German bank Herstatt failed because Citibank had sent over the hundreds of millions of dollars but didn't get back the Deutschmarks at that time. Now, since then, we have a conventional market infrastructure that's designed to serve as a handshake, and you can think of it as a virtual island in the middle of the Atlantic Ocean. It's called Continuous Linked Settlement Bank or CLS Bank. And that virtual island will hold the $500 million coming from the US on the island until it sees the 400 million euros coming from Europe. And once both have landed on the island in the middle of the Atlantic, the virtual island, then the handshake will have occurred and the euros will go on their way to the US and the dollars will go on their way to the European bank. That's very cumbersome technology. It's old, it's expensive. Uh, a much more suitable technology would be blockchain. And using blockchain, one can assign these payments cryptographically so that you don't need a handshake in the middle of the Atlantic. Let me just explain. I think virtually everybody here understands this technology, but it's worth going through it once so that we can see what's at stake in terms of how money is held on chain. So this doesn't have to be a blockchain. It can be any state machine, as long as it's programmable and it involves 24/7 multi-user access and irreversible payments. So the state of the blockchain or the state of the machine at any particular time, call it XT, and that includes the ledger accounts of every participant on the chain, as well as all the smart contracts that are sitting on the chain, determining who gets at what time. And so to affect the transfer of dollars for euros that I just described, the US bank will basically send a cryptographic message to the chain saying, I have $500 million on the chain that now belong to Joseph Chi in Europe, but they only belong to him once he similarly sends a message that assigns his 400 million euros to my bank in the United States. And once the state machine or blockchain sees both of those messages, it will use a smart contract to effect the transfer of Joseph's 400 million euros for my $500 million. And now we can each use the funds that we receive for other purposes. Now, obviously, this needs some form of programmable money, and stablecoins is the natural candidate, not ruling out every other possibility, but that seems to be the way that blockchain finance is going to go. So let me do one last example, which is actually even more exciting, and then talk about the limitations that we have today in affecting these transactions. So this example actually happened on Canton, which is not a traditional blockchain, but it is it is a programmable ledger and uses the same kind of technology. Uh, so this is, let's say today, Joseph is now the buyer of treasuries from me. I'm the dealer or seller of the treasuries. And what I'm going to do is first make sure that my treasury securities, which are held at the Deposit Trust Corporation, a subsidiary of DTCC, I'm going to make sure that my treasuries are held on chain. And then I'm going to send a message to the Canton network saying my treasuries belong to Joseph if and when he similarly sends a message to the Canton network saying that his USDC belongs to me. And those messages are both contingent on each of them arriving on the Canton network. If they both arrive within the stipulated time, then Joseph's USDC belongs to me and my treasuries belong to him on chain. And then if we want to, we can we can ask for the cash or securities to be put off chain. It's up to us. And as I said, this transaction actually occurred, and it is going to occur in a major way. The Deposit Trust, the DTCC, Deposit Trust Clearing Corporation, just got an exemption letter from the SEC that allows it to put any of 1,000 different equities or treasury securities and certain other assets in a tokenized form so that they can be owned by investors all over the world and moved 24/7. This DTCC has also stated that its intent that is that all 100 trillion, eventually, all 100 trillion dollars worth of the securities that it holds in custody for its customers will be available on chain. The exemption letter doesn't go as far as 100 trillion, but it allows a very large amount of securities to be held on chain through the most traditional custodians like DTCC. Bank of New York Mellon and State Street will probably, I predict they will go the same way. And perhaps securities custodians around the world will do something similar because this is, as Joseph emphasized, the most natural way and most efficient and simple way to move assets globally 24/7 in an accessible way, in a safe, accessible way. However, and I'm not sure how Gordon is going to react to my claim coming next. I don't think USDC is fit for purpose. In fact, Circle is designing a more robust form of stablecoin that Gordon already mentioned, based on ARC. But I'm going to address why I think that's the case. If you look at standards for financial market infrastructure for multi-trillion-dollar a day markets like the U.S. Treasury market or the repo market or the equities market, if you want to run settlement through critical financial infrastructure like this on a multi-trillion-dollar a day transactions basis, you need something that's effectively as safe as central bank deposits, reserves. And in the United States, that's Federal Reserve deposits. That is in fact, IOSCO principle number 9. This is a principle set down in Basel that international securities regulators agree on, which is that the cash leg of settlements in critical financial market infrastructure like this should be central bank deposits or equivalently safe and liquid instruments. And USDC, while it's terrific for making a car payment or a cross-border remittance or even buying coffee if you're in a place where people will take it for coffee, that's great. It can serve almost any kind of commercial or consumer application, but it doesn't meet IOSCO Principle 9. In particular, it can be backed by assets whose prices fluctuate. Even treasury bills, as I will describe in a moment, have prices that fluctuate with the term structure of interest rates, and the degree of over-collateralization that might be needed and the degree of supervision of that just simply rules out traditional stablecoins like Tether or USDC for this kind of application. You really need something that's stable to the extent that it's worth $1 every day, no matter what. So I'm going to move to in the last couple of minutes to how I think this might happen. I think the best way that this could happen would be that the Federal Reserve would begin to allow the reserves to be issued in tokenized form, and then we could simply immediately have the unit of account. The U.S. dollar is in terms of unit of account central bank deposits. Everything else is derived from that unit of account. Unfortunately, I don't think the Federal Reserve is going to issue tokenized reserves even to just banks. I'm not talking about a general purpose CBDC. I'm talking about just allowing banks to hold their deposits at the Fed in tokenized form. That would be perfectly suitable. Even today, repos run on central bank deposits. But if we want to move to a blockchain world, which is the most natural evolution for this market, we need either tokenized reserves or something virtually as safe and liquid as tokenized reserves. So let me explain, for example, why even the most stable of U.S. Treasury securities today, which is the Treasury floating rate note, is not that stable. This is the maximum and minimum prices of the last 30 issuances of Treasury floating rate notes. And these are reset to a dollar at auctions. Uh, that is, the design attempts to reset them to a dollar each at every auction. But as you can see, the minimum prices of some of these issuances get to around 35 basis points below par. And that's just not even close to IOSCO Principle 9 in terms of safety and soundness. You could over collateralize, but that's not the point of IOSCO Principle 9. It is that the unit of account that's used should be virtually the same as a dollar. So you're not relying on supervision and over collateralization. Let me repeat, Treasury bills are not safe enough as backing for stable coins that are used in multi-trillion dollar a day on-chain finance. So we need something else. In a recent Brookings paper and a Financial Times editorial, Don Wilson and I are proposing that if the central banks of the developed markets are not going to issue tokenized reserves, then the next best thing would be to have the U.S. Treasury Department issue a special purpose Treasury security whose price is literally $1 every day, or at least once a day. And I'm going to describe the design of that security, and then I'm going to conclude. So here's how it could be done. I've actually talked to people in the Treasury about this. I'm not going to give their reactions. But in principle, this is how it could be done. And I'm going to do it by example because otherwise it's too abstract. Suppose I'm going to claim that this is how you could create a Treasury security that's worth a dollar every day. And these would be perpetual. They don't need to be perpetual, but the natural design is a perpetual note that's auctioned every day, not in terms of its price, but in terms of the interest rate at which investors are willing to receive in order to pay $1 for each of these securities. So in this example, point one, Treasury today, it's not due Tuesday, that would be tomorrow morning. Treasury is going to issue tomorrow morning $25 billion at a price of one, exactly one, not approximately one. How is that going to happen? Well, uh, first, existing owners of these special purpose securities may want to redeem some of them for a dollar each. So they're going to say, put up 15 billion that they would like to redeem. So a total of 40 billion of these needs to be auctioned. 25 new ones, 15 billion of redemptions, 40 billion have to be auctioned at a price of a dollar each. How does that auction work? Well, bidders bid the interest rate at which they're willing to pay a dollar for each of these notes. Let's suppose that 30 billion of them, 30 billion of bids are saying, I will pay a dollar if I get at least 3.01% interest. There's another 20 billion that are bid saying, I will pay a dollar if I get at least 3.02% interest. And another 12 billion of bids come in saying, I will pay a dollar if I get at least 3.03% interest. Now there's 40 billion of these that have to be auctioned. The first 30 billion of them go to those investors willing to take the 3.01% interest because they're willing to get the lowest interest rate. There's still 10 billion more to be assigned. So the bidders at 3.02% interest will get the next 10 billion. They'll only get half of their bids each, and that will be the clearing interest rate will be 3.02%. Anyone that, like myself, that was too stingy and demanded at least 3.03% won't get any because we didn't bid a low enough interest rate. Now all of the securities have been allocated to investors. Everyone is going to get the clearing interest rate tomorrow, 3.02%. and that includes all the previous owners of these securities. And then we hold another auction on Wednesday, and we keep doing this every business day. And by this means, every day at the auction, these notes will trade at $1 each, and the interest rate will be sufficient to cause people to pay $1 each for these. In the secondary market, they might not trade for exactly $1, but it would be within single-digit basis points of $1. And that's not quite as good as tokenized reserves, but it's as good as you can get if you don't have tokenized central bank deposits. With this design, we think that new finance, meaning on-chain finance for settlement of very large trades in the core of financial markets, can proceed. And without something like this or tokenized reserves, it would not be sufficiently safe to go to multi-trillion-dollar a day security settlement with existing stablecoins. And I would advocate that we slow down the process that Joseph described until we have a sufficiently stable form of cash in this for this application. So with that, Long, I'm going to pass it back to you. I hope I've stirred up some controversy for our discussion.